Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Monday, April 15th, 2024. Notable data coming out today was the retail sales, much higher than expected. The last month-over-month reading was 0.9%. Estimate was only 0.3%. We expected a pretty big decline. Instead, we only got a little bit of a decline. Now, it's important when we see these numbers to take seasonality into account. These estimates take that into account, and so we're not going to dive deep into that. The important part here is that it was a lot higher than what the estimate was. And then the main headline today, we had seen last week JP Morgan earnings coming out, their interest earnings seeming very weak. And then today we have Goldman Sachs coming out and showing that their profits rose 28% during the first quarter. If you are following markets at all today, you saw a pretty big break in the S&P 500 and a number of other areas that are pretty interesting. What's causing this breakdown? Is it this information? Is it perhaps the solar eclipse that we had recently, driving fear into the subconscious of humanity, driving markets, turning them over, having them collapse? Is it the earthquakes? The answers are truly in the stars. Perhaps this is what JP Morgan meant by billionaires needing astrologers, because if you're able to predict things like this accurately, you can do pretty well for yourself if you position yourself properly. But anyway, so pretty big break in the S&P 500. As I've been saying, I had called a top here, and this is just continuing to look more and more bearish. I did a show on Friday to update us on last Thursday and Friday, and I noted how HYT had broken down, and we saw an even larger break today. In fact, this is starting to look like maybe three white soldiers, or reverse three white soldiers, right? You have the one big red candle, larger red candle. If we see even a larger one tomorrow, that could actually spell a very, very, very large move to the downside for high yield corporate. Again, I explain this on many shows in case we have new people watching. High yield corporate, these are bonds that more risky companies are borrowing money. That's with these bonds, they have to, in order to get money, they have to offer a high interest rate, and when the value of these bonds goes down, those interest rates are going up, and what that means is people are worried about higher default risks and would essentially bankruptcy risk here. I like to use HYT as the foremost leading indicator as to what's going on in the stock market. And boy, was there a lot of fear today. This is definitely not the only thing going on. It's the most solid. It's the best thing to be looking at. But adding to it, to the fear and greed index on CNN, we finally broke into the fear. I had been expecting this since we broke into neutral last week. Then we went back up to greed, back to neutral, and now we're finally in fear mode. This we can add to this. The VIX is looking as bullish as can be. This is the sort of a fear gauge based on options contracts. The value of options contracts out there, this seems to be spiking up. It seems like this sell-off is not quite over yet. We could have a peak here. It can definitely go back down. The VIX does what it wants to do, but with everything together, I expect the VIX actually short term to keep going up from here. Another thing to look at when you're looking at the VIX is the VIX futures curve. And when it's inverted like this, in other words, it's higher at the front than uh, where it is further down in the curve, it means there's a premium on the current VIX, and so it's expected to decline in May. And so when that's the case, it's like uh, yeah, it's just another indication that there's more fear here. And the more inverted this gets, the more fear there obviously is as well. I found it to be quite fascinating today that the 30-year Treasury yield had jumped, which means TLT, the value of Treasury bonds, had really plummeted today. This was unexpected for me. Typically, when there is like a crash in stocks, there's a bit of a run to safety, and a run to safety means people dive into treasuries because it's a guaranteed return. It's where you can, you can hold this debt instrument that has guaranteed returns on it. And we're seeing some yield being added to it. If we take a look at the charts, I think my best explanation for what's going on here is if you take a look at this longer term trend line that really goes back to April of 2023. You could argue even further back than that. That we have a lot of points where this thing hits. We hit this line today, and so this could be just a trend line thing that we needed to get there before we can bounce back up in the value of treasuries. I bought a lot of treasuries today to maintain a 40% allocation. I'm very, very happy right now to be in treasuries with what I see going on across markets. And yeah, so let's move on to more charts. Adding to the bearishness, this is XHB, Home Builders Index. We're seeing a little bit more fear here. This market seems to be curling over, turning over. Wanted to also mention ARK, ARK-K. I consider this at this point to be like the very dumb money right now to be invested in something like this while interest rates are so high and the Fed is trying to strangle the economy and most of these companies don't even make any money. There's a lot of dumb money still left in ARK, and I think there's room for this to collapse. And we had fear here. We don't have enough buyers to hold this market up. We broke below. Well, you could consider this to be sort of a double top pattern here. We're below the bottom of the M right here, which also signals to me that it's likely that we will head lower here. And then the Qs, I've been talking about how I have 5% of my own portfolio short the Qs, and boy did I do well on that today. The Qs certainly broke here. Wow, now that I'm looking at it a little more closely, this red candle is very similar to this last Thursday's big red candle, and so this is just looking as bearish as can be. One of the hard things about shorting a market is knowing when it's time to get out. Gareth Solway is predicting a 10% correction in markets right now. And because of that, and because of how great of a chartist he is, I'm going to aim for 5. If we get we might even be there. I might have to actually get out of this position now that I've correctly shorted this. But I'll do that later, and I'll update people tomorrow if I got out or not. Pigs get fat, hogs get slaughtered, so, gotta be enough of a pig, but don't be a hog. Don't get yourself slaughtered. In other words, lose all the gains that you got just from this move. Can I predict the future? Do I have a crystal? I'm the guy with the crystal ball. It's gonna keep going down. I know it. I've been talking about wood and how trend line I pointed out a while ago, how we keep hitting it almost methodically and rolling over. And when we were up here, I said it looks like we're going to be rolling over here, and it just keeps rolling over. So it's fun being right so much lately. I've been doing very well with my crystal ball predictions. One thing that I've not done so well in is actually that's starting to scare me off a little bit is the Brazilian ETF EWZ. I still think that this is an long undervalued market in these equities. The Brazil has a lot of companies that make a lot of money, and the whole stock market basically in Brazil back in 2008, it looks like, was around $101. And today, many years later, we're still only valued around $30. Meanwhile, these companies just keep on making lots of money. I think that it's inevitable we still break out higher from here. We broke this trend line, though, to the downside. And so, you know, some people may be stopped out here if they're really depending on just technical trade. Gareth Solway himself, who had been talking about this chart as well, um, he might be stopped out here. I don't know. One thing to look out for is what's called a confirming candle. So what you want to see here is this is a weekly chart, by the way, and so one way to confirm it would be if this week stays here and then next week we have a close below the lowest point of this week. And so we'll see if we get a confirmation below this line, and if that's the case, well, I might have to reconsider my position here as far as chart patterns go. However you want to look at markets right now, they're exciting. Things are happening. Things are moving. The VIX is finally popping after being so calm for so long. We've had such a huge run up in the S&P 500 where everybody was trying to see, is this thing going to crack? Lots of people, including myself, have been thinking it literally can't go up forever. You only have so many people willing to bid up the price before there's nobody left to keep paying more for the same shares. It's kind of a thing where if you're in a room with 100 people and you pass around a box, if you watched the MIT series on there's a financial course, it's free on YouTube. He does this and talks about this, how you have a box and one person buys it from one person for $1, next one says, oh, $2, $3, $4, and it keeps going around until nobody has any money, and then it's worth nothing. So it's eventual. It was inevitable. It's inevitable that, by the way, any market eventually calms down and starts to have things make sense to some degree. At the end of the day, a stock is nothing more than the potential future earnings, the potential money that the company can make. That's, the intrinsic value of what a company is. And when valuations just go overboard, it's just a matter of time before the market has to reconcile with the truth, with what's real. So that's all I have for you for today's show. I hope you enjoyed watching, and thank you for watching. Robschild.